Rahul Bhasin joins us now. Let's take a conversation forward with him, understand that what his view of the market is and what his view of the world is. Rahul, fantastic to have you back. Thank you for joining us.
My
Rahul,
pleasure.
From a belief that markets would remain in a ultra low interest rate regime where bond yields will remain low, below in and around 1% for a long period of time, there is a sudden departure in market positioning. Now that yields are strengthening, should one get worried about the change in setup and change in scenario for global liquidity watchers and investors?
I think a lot depends on which geography you're in. I think the US has a peculiar set of circumstances, which is probably going to be hard for the overall economy and the asset prices there, just because of the sheer quantum of QE that has been given. Almost 14% of their Fed's balance sheet was expanded during this QE, and it was done rather rapidly. The manner in which it was done was largely in terms of payouts, not really investments, not really changing, but really simply handouts. If you look at most of the rest of the world, I mean, there has been the same in Europe, in Japan, but most of the rest of Asia, that hasn't happened. India has been very, very conservative. So would you expect higher inflation and higher rates therefore? You could, but my own sense tells me that most central banks will be still quite reluctant to raising rates very suddenly. So that might happen, but it will happen gradually. I think you might get what I call supply constraint inflation in the world. That might stem from the fact that after the global financial crisis, there were no investments in the commodity ecosystem. So you're finding a lot of commodities, they're running out of ore right now. The extraction rates are falling, they're supply constrained. And you might get a price push as far as that is concerned to enable the next round of reinvestments. And that's just the way the commodity cycle behaves. So it's nothing to be concerned about, but that's, to my mind, that is a reality that is there to stay. So that ecosystem is going to generate returns. I think we are due for a bout of supernormal returns in that entire ecosystem. And I would say that's true globally, simply because of the large lag in the investment cycle. In a place like India, I think that interest rates going up could it impact capital markets for sure, just because the valuations overall are fairly reasonable for the current kind of interest rate regime. But if interest rates were 200, 250 basis points higher, I think that you would find that valuations would look stretched. Now, can they go up 200 basis points? I mean, there are scenarios in which that can play out. But to me, that's not the most likely scenario. I think that our inflation basket is largely driven by food. And I think if food inflation is there, which is also tempering actually, I don't think that that's going to that actually puts more purchasing power in the hands of the rural areas. So I think that we will live with that slightly higher end of inflation. And I don't think RBI would like to raise rates in a hurry. And I think that's probably the right policy prescription at this juncture. I also believe that with that kind of mix, what's likely to end up happening in a place like India is that you will end up with another CAPEX cycle, and that will be pretty much across the board. I think CAPEX in India peaked around end of 2011, first half of 2012. After that, we really haven't had a CAPEX cycle, and it's been almost a decade now. And I think that once you get a wider CAPEX cycle, which is what I'm expecting, I think that you will find jobs will be created, growth will be stronger, and I think that we'll be okay. I don't expect rates to go much higher. There are also lots of capital which is going to come in. I think a lot of the reform which has happened over the last several years, none of it attained what I call critical mass in reforms. But I think the cumulative impact of it is definitely been quite strong, and I think that you will see the benefits of that. You also, I don't know how far government will be able to go through with the privatizations, which they've intended and announced very strongly, and I applaud that. But if they can get through with that, then the increase in productivity in the economy will also allow for higher growth without higher inflation. So I think we're in a delicate position at this moment, but I'm kind of optimistic that we will get through this without too much muddles. And when you have strong earning growth, even if your discounting rate goes up, what tends to happen is that earnings catch up quickly. So you end up, instead of getting very steep price corrections, you might end up getting bouts of time correction. And I think that's the way it will play out. You will get the sort of short-term volatility all the time. And that's, as you're seeing today, I think that's part of markets and how they behave. And I think we should expect that.
Sure. Rahul, given the way the market texture and the economic recovery is moving, would you say that you're safest sticking by with the cyclicals? Because whoever we've been chatting with tend to believe that cyclicals really is the place to be in right now, and that's where you're safest in that sense.
Well, it really depends on your timing perspective. If you're trying to generate alpha over the next 2 quarters or 3 quarters, probably that might be a good play, because a lot of the cyclicals, earning multiples are of very depressed earnings. I mean, from a structural basis, they're at very depressed earnings. But there are so many opportunities today because I think overall, if you look at our environment, our ecosystem, one of the things that very low cost of capital has done over the last 10, 12 years, and that's been prevalent around the world, is that there has been a lot of innovation. Innovation is usually capital hungry, and it sort of absorbs a lot of, and when capital is low priced, it tends to accelerate, and I think we've seen that. So you're seeing disruptions across a whole bunch of ecosystems. And I think that for any investor with a slightly medium to longer term horizon, that also gives you ample opportunity. So I think that I would sort of overlay that and say that to my mind is even a more attractive opportunity. I think for somebody that's playing the public markets and maybe the cyclicals make sense, I would sort of put in a word of caution on the cyclicals, though, that the highest beta companies tend to be media and financials usually. Media is going through a lot of structural changes, a lot of where the advertising, money is being captured is not in the older platforms. It is moving to digital platforms. It is getting fragmented. So the sort of intuitive or the old-time bets that people would take, I think may not work quite as well this time. And with financials, I think we have to be cautious of the fact that, the RBI gave you a moratorium. Some of the sort of bad loans got pushed out. That might, and the recognition got pushed out. That might come back and might sort of be an impediment in terms of how quickly these banks come back. But I think the best run banks with the strongest balance sheets, the growth opportunity is going to have, is going to kick them along, and I think that therefore the market favorites will do very well. I also feel that there is also a lot of opportunity for those who are driving. To my mind, banks are becoming bundles of. They're essentially, deposit takers with a regulatory architecture to protect the deposit holder, and then they're transaction enablers, and they're risk assessors. And they have some kind of customer UI, and all of those, to my mind, are becoming more and more technology plays. And really, it's to my mind, a bank is becoming more like a technology company, which is allowed to take deposits. And I think that the ones who transform themselves along those lines are going to do very well from a 5-10 year perspective. But right now, as we speak, I think the ones with the strong balance sheets and the relatively conservative accounting will do very well. I think some of the NBFCs are extraordinarily well placed at this juncture to capture some of this market beta. They tend to do very well at this kind of point in the cycle. And so I think the ones who don't have any kind of bad loans kind of issues, I think the gold companies would be amongst those. I think they'll do very well at this point in the cycle.
That's exactly what I wanted to talk to you about. Gold loan companies, do you think they would make good for longer term bets as well? Because, gold is also turning out to be pretty volatile as other equity asset classes as well. Does this investment thesis stay put for the long haul? That's your gold finance companies.
The way I look at them, we have very large investors in this company called Manappuram, have been for over a decade. The thesis has played out extremely well for us, and we think that it has a long runway going ahead too. If you're talking about businesses which have over 6% return on assets, remember HDFC Bank's return on assets is 1.6%, right? Which has capital adequacy of 26%, return on equity of over 30%, growing at over 20% a year, and available at multiples that, which are in single digits. I find it very hard to figure out how you can go wrong in such an investment, which is why we are investors. That's my own perspective. Now, there is this entire thought process that the digital-oriented companies like a Bajaj Finance, etc., will eat up everybody's pie. And yes, I believe that digitization, etc., is very important. But I think, to my mind, what the market misses with a lot of the gold loan companies is how digitized they already have become, and how much of data mining they're doing vis-a-vis their customers, and therefore using that to expand their footprint and their client engagement, their client lifecycle engagement. I think that would make their entire models quite sustainable, according to me.
Rahul, you've invested a lot in mid-cap IT. Now that the run-up in some of the IT stocks is more than 50 to 100%, do you think some of the investments which you made, let's say 2 years ago, 2.5 years ago, when valuations were distressed, especially in mid-cap IT, do you think it's time now to reap the benefits? Is the springtime over? Is it time to pluck the fruits from the trees?
Let me differentiate a little bit what might be right for us. Our cost of capital is very high, and our hurdle rates are high. We have compounded money just short of 30% per year for 22 years. So if you're looking for those kinds of returns, maybe mid-cap IT at this juncture may not afford you that. There may be companies which are extremely niche and operating in the cloud and digitization of very specific areas, or cybersecurity, which might still give you those returns. But broadly, I would say the mid-cap IT pack will not give you those kinds of returns. But for an average investor who's getting 4 or 5% in his deposit rates and is looking to make 12% compounding returns over the next 4 or 5 years in a very safe place, I think mid-cap IT will give you those kinds of returns quite safely. So I think it's a different sort of menu for different people. But I think there is still a lot of growth left for large cap and for mid-cap IT. I don't think that we're running out of growth anytime soon. And they're very efficient users of capital.
Your way, which is that where you are...
Apologize.
Oh, yeah, they are. Indian IT sector, hats off to them that they grow without raising capital and they maintain their ROS, which is quite efficient. Okay, so my next question is something I'm going to take a leaf from your initial comment, which is that if one looks at your enviable track record of giving the CAGR return, which is north of 20-25%, where do you think that kind of an CAGR return is there in the market? Where would you pick your spots? Today if you have to, let's say, raise capital, and assuming that you put your whole matrix and modeling, which has worked like a charm. Where are you picking that kind of a sizable opportunity for next 2 to 3 years or 3 to 5 years, or even 5 years beyond?
Okay. So we never think in less than 5 to 10 year kind of time frames in terms of whatever we do. So I should sort of put that as a caveat. But my own thought process is that if you look around the world, I mean, we are going to grow. We're going to embark on that next growth cycle for India, and I think that that's pretty much here. So everything will do well, and but what's going to do better than other things? I think one of the unique things about India is that we're a highly populated country. The population density here is higher than any other place. So I think that our sensitivity to some issues is going to be much higher than others. What do I mean by that? I think our sensitivity to environmental degradation, our sensitivity to waste and our waste management challenges are going to be significantly higher. So I think you will inevitably find, whether it's the policy mix or whether it comes from a groundswell of public opinion, I think the political classes will have to pick this up. So I think that recycling businesses are going to become big. You're seeing this incentive structures for manufacturing. I think that it is inevitable that it will go into the recycling businesses. I think that our knowledge on environment, human health, etc. We have held this entire principle that microbes are bad for you, kill them, destroy them, and there's a lot of products in the market which are sort of focused on destroying microbes. Whether in your toothpaste, your Colgate Total has something called triclosan in it. Your Synthol soap has triclosan. It's found that it does a huge amount of damage to human beings, to aquatic life, to water plants, etc. So this has been banned in several countries. It's still there in a lot of our products today. I think that companies which actually identify these kind of harmful things and produce products which don't have these kinds of harmful things, there are parabens in shampoos, there are phthalates. I think a lot of these kind of chemicals in household, regular household things, I think that's a massive opportunity for someone who offers clean alternatives. I think the education is increasing. The availability of access to these kinds of, the knowledge around this is increasing. It is inevitable that the markets will move in direction. Packaging. Plastic packaging is not an issue which is going away. Our landfills have limited size and scale. I think recycling of packagings, I think it's inevitable you'll find differential tax coming in and companies that package. I think you'll all, which use recyclable packaging versus the primary packaging. I think the entire thought process has got to be that, is this company making products which are sustainable? Is it friendly to the environment? Is it doing damage? I think that thought process has got to creep in, and I'm talking purely from a commercial perspective here, because that's inevitably the direction in which a lot of things are going to go down. I think that recycling 40% of Indians have made a statement that they want to replace their smartphones within the year. 40%, right? Now, if that were to happen, sure, it's great for smartphone companies, but what happens to e-waste? So I think that anyone who addresses e-waste is going to have a massive opportunity. The other thing is that to bring back to my theme of disruption, I think the time has come for electronic vehicles, etc. I think that's going to be big, and it's going to happen much faster than people think. If you look at the operating cost of EVs today, it is significantly cheaper than that of the IC engine. I think people who have high utilization of vehicles, and that to my mind would be all the commercial users, are inevitably going to start moving towards that. There are still limitations in terms of range and sort of long-term, how far you can go with a single charge, etc. But therefore, you'll have intra-city transport and buses and those kinds of things you will find moving. You'll find two-wheelers, where the requirement of power and energy is muted. You will find two-wheelers will find adoption of EVs happening very dramatically and very quickly, which ends up with having lots of winners and losers in the listed markets too. So I think that's these kinds of opportunities are going to keep cropping up. I think awareness of food safety is going to increase dramatically. A lot of the pesticide, insecticides that we use, the toxicity that leads to human beings, I think the awareness of these things are growing. You will find, the organic solutions or the farm to fork, without the intermediate conditions. I think you will find this kind of evolution in marketplaces, and this is going to lead to a lot of investment opportunities. So we can carry on talking about these things, but the short point is that innovation, disruption, greater knowledge, greater, I think more sustainable growth is what this country needs, much more than what other countries have needed just because of our density of population.
All right, Rahul, we'll leave it there. Thanks so much for joining us this morning and sharing with us some of the latest trends and your insight on that front.